Good morning and welcome to the Surgical Innovations Group plc full year results investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and they can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. Simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I would like to submit the following poll, and I would now like to hand you over to CEO David Marsh. Good morning to you.
Good morning, everybody, and thank you for joining us today. I'm joined by John Glenn, our chairman, and we will run through the slide deck that we have prepared for you. John will run through the financial aspects, and I will run through the operational and commercial side of things. So if we start the presentation, we're looking at a number of areas in the business where we can drive the business for growth. And I will touch on it in a lot more detail later on, but we're looking at opportunities to expand the Surgical Innovations branded portfolio. And some of that you will see later on in new product development, particularly around a device called Logitube and the opportunities that we have there. And also sort of continuing to drive our sustainability messaging, because that is a key driver for us in a number of key markets. We're also looking at leveraging the relationships that we have in a business, and a typical example of that is within the private healthcare provider sector. As you all know, the NHS has a significant backlog of elective surgery, and the recent investment, 2.4 billion by the government to reduce these waiting lists, a lot of that is going to be directed at the private sector to help the NHS reduce those waiting lists. Our business model in the UK, the distribution model, that works really well. It continues to grow, and we are leveraging that with both our existing suppliers, and you'll have seen the distribution agreements that were announced today, but also looking at other third-party opportunities that we have in the UK. And we have a number of commercial agreements under negotiation, particularly around or with organisations that have a business already in the UK, either through a direct operation or through other distribution channels. And we're bringing those under the Elemental banner. So that will be another opportunity for us to drive business going forward. We talked a lot at the interims and moving forward about some of the operational challenges that we had last year and the impact they had on margins, and we're continuing that improvement plan, and that's an ever-evolving plan. So we're looking at ways that we can reduce costs to enhance returns, and continue to drive efficiency through the business. We've had a stated goal of achieving 30 million by 2030, and the ways that we're looking to do this is through organic growth. Obviously there is an aspect that won't get us to 30 million, but there are other opportunities, new third-party products, new distribution agreements, and then licensing opportunities, and then ultimately when we're in the right place, we can do some or look at some M&A opportunities. So if we look at commercial and operational highlights for last year, so the business finished with record revenue just over 12 million. The key markets, UK, Japan, and the European markets were strong, and we're seeing sort of some improvement in the rest of the world going into this year. We had a number of challenges around our operations and around our supply chain challenges, well advertised, increasing cost of goods, increasing energy costs, and also you can tack into that as well about increasing cost of living. We've implemented a plan to drive those efficiencies within the business, improve margins, and we expect to see margins improve throughout the rest of the year. Some of the new markets that we approached during last year are in India and then a new route to market in Canada. They're beginning to gain traction, and we'll see that business continue, and I'll touch on more detail later on. And then importantly, on the transition to MDR, that remains on track. Progress is slowed by the bandwidth of BSA rather than any reflection on our business. But we are just now awaiting the final sign-off for our Logi and Logi Logic and Logi range of products. So that continues to transition nicely. So if we look at the UK grew by 8% last year, and particularly pleasing, we saw good growth in the SI branded products of 15%. I alluded to the extended agreements that we have with Microline and Peter Surgical, and you will probably have seen the RNS this morning. So those deals are worth over the sort of current run rate. The Microline deal is worth about 9 million. The Peter Surgical deal is worth about 1.5 million. And they're an important part of the third-party portfolio that we have within Elemental. But it's also an endorsement of the UK sales team and the structure that we have here, and the way that they're trained, and the way that they're developing the business. And part of that is, as I alluded to earlier, is looking at the private healthcare providers. And we have recently signed 2 new supply agreements with Spire Group. So that places us really nicely to take advantage of the additional funding to clear the backlog of surgeries. We're also, as I talked about earlier, we are also in conversation or concluding new distribution agreements with companies that have existing revenue streams in the UK. And we anticipate those to filter through into the business over the next 6 to 18 months. Real opportunity, those deals. Our investment in the sales and marketing team, throughout this process of restructuring the business, we've maintained our investment in sales and marketing to drive that, to drive growth and to drive the sustainability messaging. And we've seen a real benefit from that, and that is what is attracting some of these new companies to Elemental as well. And we see that as a real opportunity going forward. In terms of our European business, we're now back above pre-pandemic levels, which is good, 7% growth, and the business is continuing to drive throughout this year as well. We're seeing sustainability resonating more and more. We're working in a number of key countries around the sustainability messaging, and Belgium is a typical example where, in conjunction with the Belgian government and our dealer there, the Green Deal initiative is helping to, or is driving a clinical process to understand the sustainable benefits of SI products within those accounts. We've launched, as of last week, we've launched the Logi Tube, and I'll talk about Logi Tube in more detail later, but just suffice to say it's a significant opportunity for us, and that product was launched at a dealer meeting last week. The US remains a bit of a problem child for us. The growth isn't where we want it to be, and we've seen that business suffer a little bit in terms of our scissor business, where we had a nationwide alliance of dealers. We've reverted back to Adler in the southeast. They look after 11 states, and then we are cherry picking some dealers in key areas like California, for example, where sustainability is resonates more than perhaps it does in the Midwest. For Microline and the access devices, the uptake has been a little bit slower than we anticipated. We're working on revised training. We have a team in the US at the end of April, early May, that will be retraining, co-traveling with them and building support and working with the sales team to give them confidence to sell Yellowport Plus. We also anticipate the launch of Logi Tube in the US, but that's subject to regulatory, but we're hoping to have that done by the end of Q4 so we can launch that product there. In terms of the APAC business, again, continued growth there, 8% growth, primarily from Japan and India. We had a bit of a slow start in India last year, but that's now really beginning to maintain or to gain some traction. We've spent a lot of time there co-traveling with their sales team, driving the sustainability agenda, which interestingly is a government-backed thing, and we see that as a real opportunity for us, as well as on the back of our relationship with CMR. In Japan, although there were delayed regulatory launches, we have launched Yellow Port Elite there now, and the optical trocar, and shortly we'll be launching the cutting shielded trocar as well, which completes the range. In the rest of the world, we have strong growth, 45%, albeit on a low number to start with, but it's still good growth. We have new routes to market in Canada, and they've really taken up the sustainability messaging. They utilise our financial and environmental calculator to good effect, and we've seen a particularly bigger win account in Quebec, and that continues. Our partners in Israel have won one of the biggest hospitals there, and we see that business growing as well through this year. And the launch of Logitube offers sort of a significant upside for us. It's already launched in Israel, and they've placed their first order with us, and we're hoping to get it registered in time for a Q4 launch in Canada. From OEM sales point of view, the business has grown 5%. We had a number of challenges at the tail end of last year around some particular components that were causing a problem, and some supply chain issues that did cause some delays. We carried a significant order book into Q2 as we cleared up these issues. We see the tail end of that now. We think we've solved the problem. We're manufacturing flat out to clear the back order, and we expect that to be fully cleared in Q2. So in terms of a bit more detail around some of the strategic growth opportunities, so enhancing the SI brand is an important part, sort of their products which we control. We can improve margins on those products, and Logitube is a good example of that. So this is a product that Elemental sold in-house. Sold in the UK. We bought the product in-house. We manufacture it ourselves now, and it's an own branded product. And this now allows us to sell into markets in Europe, in America, and ultimately the rest of the world. So it's a real example of how the relationships we have through Elemental, we can then bring back in-house and then extend globally. And it's a significant opportunity for us. So this device is used in obesity surgery, in gastric bypass and gastric sleeve, and is a calibration device to make sure the lumen is the correct size, and provides an accurate guide for when the surgeon removes the excess stomach. So there are about 500,000 procedures annually, and we now have an opportunity to go after a significant chunk of that business. Talked about leveraging our relationships with the private healthcare providers, and this is a real significant opportunity in the coming years. The government have announced 2.4 billion extra funding. A lot of this will be directed to private healthcare providers, and it's a real opportunity for us to capitalise on this. We're well placed to take advantage of it, with Spire Healthcare, which is one of the larger providers, but also some of the other providers as well we have good relationships with. We continue to consolidate our relationships both ways, actually. So the deals with Microline and Peters are important for the UK business, but we also have relationships with those companies in the US with Microline and in India. And it's a good way to consolidate that relationship, strengthen it, and we have a number of projects where we work together on some around sustainability, but some around some clinical trials, particularly with Peters, which have proved to be fruitful. I mentioned earlier about some of the agreements we have with companies that have existing revenue streams, and so these were attracted to us because of the performance of the Elemental business in the UK, the quality of the sales team that we now have trained, our marketing strategies, and these are companies that have approached us, and as I say, we will gradually take over their existing their existing business in the UK, and over the next 6 to 18 months, we'll see that come in-house and provide us with a real boost. And then importantly, one of our key drivers is around our sustainability messaging. This continues to resonate. It continues to drive our business, particularly around yellow ports. And we see that in key markets, both Europe, both in the US, in Canada, and particularly in the UK. And the image you've got there is around the sustainability argument. Is our financial and environmental calculator. And this is a key tool for all of our sales teams. And it allows them to do a comparative data of the competition that is being used in the hospital to identify their costs, to identify their CO2 footprint, and to identify their plastic waste. And then it gives a comparison of what that would look like if you utilized SI branded product. And it's a really effective tool. It overrides the conversation around pricing. So from a compliance perspective, this sort of moves at its own pace. BSI have bandwidth issues and keeps things slow. For example, the cutting shielded trocar, which I will talk about in a later slide, that took us 6 months to get a view on whether it was a line extension or a new product submission. They have challenges in-house, and we're working through those, which is why Logitube is such a great product, because it's a Class 1 device. We also have UKCA mark on all of our products, so that allows us to continue selling in the UK, which is obviously good for the business. And we continue to successfully pass audits for MD-SAP, ISO 13485, and register products in key markets as well, like Japan and the US. So in terms of new product development, the team are working in under three pillars. So new products, which we launched in last year, Logitube, which I've spoken about, that is a real feather in our cap, the process. So we started that process in September, and we launched in the UK in December 2023. So a real speedy process for a Class 1 device. We launched in Europe last week, and we're launching in the US, hopefully in Q4, subject to registration. As I said earlier, this product gives us the opportunity to go after a 500,000 worldwide number of procedures, and we have real opportunities there in all of our key markets. Elite Cutting Shielded Trocar is a line extension, and allows us to complete the range, the Elite range, and addresses sort of particular specialties, mainly gynecology, who like a cutting trocar for their surgery. In terms of materials and design, and this is one where I think we have some significant opportunities to drive down cost within the business. So the first graphic you've got there is of a TPE bellows, which sits in the universal valve. Currently, this product is silicon and is outsourced. By switching to TPE, we can injection mold it in-house, and it reduces the cost by about £1.50 per valve. And this project has been going on now for a number of months, but we think we're now at the final stages where we can implement this, and it will allow us to drive efficiencies and utilization of our injection molding capacity, and it will allow us to bring down component costs. So it's a really good project for us. And then if you follow that through into the design stage, where we're looking at cost down initiatives, the graphic you've got there is of the universal valve and the components that are in-house. And currently we have like a petals, which acts as a valve on the top, and then you have a duckbill valve further down. By molding that in-house, and again, we're looking at changing that to TPE, it helps us drive down cost, but it more importantly improves the efficiency of assembly, because you're taking components out by combining them. And then that speeds up the assembly process as well. So there are a number of opportunities around materials and design on all of our products where we can take cost out and improve the assembly of the products. In terms of new product developments and the projects we're working on, so talked about Logitube, and we're now looking at illuminating the Logitube, and that will allow surgeons to have more accurate. So if you imagine, obviously these are used in obesity cases. Quite often when you see it, the image you have there is quite clean, but quite often because these people are obese, their omentum is very fatty, their stomach is very fatty, and actually being able to identify in some of the more complex cases, especially if there are adhesions as well, it's difficult for the surgeon to identify exactly where the tube is. And by sticking a light cable through it, and that fluoresces on an infrared camera, they're able to identify exactly where it is and where they need to be and where to make the resection of the excess stomach. And then the final one on this is a low-cost scissor project. So for very, very specific markets, India, for example, where they use low-cost scissors, we're looking at this project where we injection mold the shaft as opposed to using machining an aluminium shaft, and taking cost out, or significant cost out, and reducing the number of components to make it a lot more cost effective to produce, to allow us to tackle some of these low-cost markets. And then in terms of manufacturing and our capex, I talked last time about some of the initiatives that we have around automation and robotic processes, and this slide gives you a graphic illustration. So the top slide is of, so we glue the top seal to the duckbill valve, and that's been a very manual process, and takes up a lot of time in the valve room. We've now introduced an automated process, a robotic process that glues, dispenses the glue and attaches the valve, and has enabled us to take a number of people out of the clean room, out of the valve room, to drive that process forward. And then on the other side, you've got an automated dimensional inspection device, which allows us, in the past, or because we're a heavily regulated industry, we have to calibrate and inspect all the dimensions on a certain number of each component that passes through our clean room. This device allows us to do it en masse, and is very effective, very quick, and shows when any product is out of dimension, and we can easily discard that and continue on. So again, it drives efficiencies and enables us to take headcount out of our QC department. So now I'll pass you over to John.
Perfect. Thank you, David. Good morning, everybody. I'm John Glenn, Chair of Surgical. Became Chairman late last year. I'm going to run you through the financial highlights. David's touched on a lot of this, so I'll be relatively quick, and then we can open the floor up for questions. Revenues at just over 12 million, record revenues for the group, which was very pleasing. A near 6% sales growth. Underlying margin adjusted EBITDA of 0.2 million and operating loss of 0.69 million. The year-on-year organic growth came across the board, really. So Surgical Innovation branded sales increased 6.6% to 5.93 million. Distribution showed strong growth as well, 5.2%, rising to 4.26 million. And OEM sales were also over 5% to 1.83 million. Commercial, the margins reduced to 37.9%, and this was the challenge the business faced last year. Operational challenges alongside supply chain challenges and inflation. We undertook a comprehensive review of the operations with an external consultant. That review is complete, and the benefits of those changes in the operations will flow through this year. We expect the margins to return to a more normalized level, which would be over 40%. We should be close to that by the end of this year, certainly be there on a run rate basis. We also have taken some cost out of the business, both through organizational efficiency and through some automation in the business as well. And so addressing all of that to return the margin back to where it should be has been a key priority for us as the sales have continued to grow. Adjusting operating expenses increased to 4.1 million. We've continued to invest in sales and marketing. So we haven't cut that despite the challenges we've had. Regulatory costs continue to be high due to NDR, which David has touched on. We've broken the back of that, so you will see those costs, the NDR related costs, starting to reduce. We obviously do still see inflationary pressures, but it was good to see that inflation is continuing to reduce. And the cost reduction earlier in this year, a reduction of about 11% of the workforce, has saved about £500,000 on an annualised basis. So a part of that will flow through this year. Looking at the balance sheet, capital expenditure was 0.28 million, and investment in product development 0.42, so about 0.7 million there. Inventory has been too high, tying up too much cash. You can see that's reduced from 3.16 million to 2.85 million, and we continue to work on that. I expect that number to reduce further. We have a cash headroom of 2.12 million. That includes a 1 million undrawn discounting facility, and our bank remains supportive. And in the announcement today, you can see the support that they've given us and some tweaking of the covenants for this year. So I'll just hand back to David to do a short summary, and then we'll take questions.
Thank you, John. So as we take a look at the outlook of the business, we have a very strong order book for Q2. This pipeline of orders demonstrates a strong demand for our own branded products, our OEM products, and also for our distribution products too. So we're in a good place for Q2. As I said, we're seeing increasing demand for our own branded products, and this is primarily on the back of the sustainability messaging, which continues to resonate in all of our key markets, and that we see as a real opportunity for us going forward. New product launches provide a significant opportunity for us. LogiTube, as I said, was launched in Europe last week. We've received initial evaluation orders already for that product, and we anticipate that growth to be reasonably quick through the rest of the year, and to take some significant market share of that product. Importantly, we secure long-term agreements with key suppliers, Microline and Peters being those two on this occasion. It does underpin how effective our distribution model is in the UK and the sales team are, and provide us real opportunities to attract new third-party products as well. New supply agreements with the private sector in the UK, that really allows us to capitalise on the NHS as they rely more and more on the private sector to reduce the backlog of elective surgery. And again, that is a significant opportunity for us going forward. And then from an operational point of view, we will see the benefits of the changes that we've made. And we see that continuing to filter through to the bottom line throughout this year and into next year, and will improve the efficiencies of the plant, will drive cost savings, and will make the company more competitive. So that concludes our presentation, and we're very happy to take questions.
Perfect. David, Jonathan, thank you very much indeed for your presentation. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated in the top right corner of your screen. While the company take a few moments to review those questions submitted today, I would like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via Investor Dashboard. David, Jonathan, as you can see, we have received a number of questions throughout today's presentation. And Paul, if I may now hand back to you to chair the Q&A, read out the questions, and I'll pick up from you at the end.
Thanks very much. A few questions that Jonathan will tackle first. One of them is fairly direct. How can you explain the share price and the total lack of stock purchases by the board?
Yep, that's a fair question. The share price I can explain in two ways. One is small cap healthcare on the AIM market has struggled across the board over the last few years. AIM is a difficult market at the moment. We have self-exacerbated that by by putting out a profit warning at the end of last year, reducing our forecast. And in this type of market, the market is pretty punitive. So the share price is pretty pitiful. We are very focused on turning that around. It's what I've done in some of the other businesses that I chair. The way we do this is to regain the confidence of the market by consistently delivering on market expectations over a period of time, and then the market will readjust the share price. But the market capitalization is about a third of sales at the moment, which is very low, but understandable, and we're working hard to address that. On the lack of stock purchases by the board, David is a very, very significant shareholder in the business. He holds significantly more shares than the majority of PLC CEOs on either AIM or the main list. I actually acquired £30,000 worth of shares when I joined the business, so I don't agree with that statement.
Thank you, John. Apologies also that we're just having some trouble getting David's camera on. He is still here, but you're taking the questions for the moment, John. There is another one that's quite direct here about, is the market share price, is the share price reflective of the fact that the market thinks that you're pricing the company for bankruptcy, or that there's news of a discounted placing that's been leaked? Is that what you're seeing?
Absolutely not. I mentioned the cash headroom of 2.12 million, so bankruptcy is not on the cards for this business. The sales continue to grow, and as I say, we're sorting the operations, so that will return the business to bottom line profitability. I'm not sure where this highly discounted placing has been leaked has come from, because that's simply not true. There's been no discussion at the board about doing a highly discounted placing, so that is a market rumour that has been started by somebody not connected with the company.
If we may stay on the subject of share price, one investor's asked, what do you think will reverse the fortunes of the share price? And they also then have a follow-on question regarding why margins have got worse after you spent a year improving efficiencies. But perhaps what you think would return the share price to higher levels, maybe.
Sure. So hopefully I've addressed that. In a difficult market, warning on profits after a lack of historical performance is always going to hit the share price. The way to address that is you have to rebuild confidence, and that is to deliver a number of sets of results. So obviously, we announce in the UK every 6 months. Hitting the numbers that are out in the market, hitting market consensus, showing the continued growth, showing the new products coming through to market, showing that we're improving the margin through the operational efficiencies. All of those will address that.
Are you okay to address the second part as well, which was specifically about why have margins got worse in these set of results when you're delivering operational efficiencies?
Yeah, I think the question talked about when you've been doing this for 12 months. This actually only started in the last quarter of the year. So we brought in an external consultant to look at those operational efficiencies. So that period of work goes on for 3 to 6 months, and then the benefits of that start flowing through, which is why I alluded to the fact that actually you're going to see the margins start enhancing this year. So if we get to the end of this year and the margins haven't enhanced, that's the right question to ask us.
Thank you. One investor was asking about how does UK revenue for 2024 look like, likely to look like compared to 2023?
Well, UK revenue grew 8% year on year this year, and the consensus is that we're going to grow revenue across the group, consensus in the market, and we would expect UK revenue to continue to grow.
Just turning to a question on research expenses. With the investment in research expenses amounting to 9.2% of revenue, how is the company balancing innovation with financial prudence?
Yeah, that's a good question. So the lifeblood of any business in our sector is to ensure that we're innovating and delivering new products to market. The easiest thing for David and I to do is save some cash and increase the profits of the business by cutting out all the R&D expenditure. That will have a great short-term impact for about 2 years, and then suddenly you'll find that the whole business is unviable moving forward. So it's a constant balance. What we do is we allocate as much as we feel is sensible into that new product development, R&D, etc., etc. That happens to be 9.2% this year. It's not out of line with similar businesses.
David, I'll just bring you into shot for this question because I think it'll be relevant for you.
Yeah.
What initiatives are being undertaken to address the decline in sales in the US that you mentioned earlier and to capitalise on the strong order book entering 2024?
So that's 2 questions really. So the US, I talked earlier about the fact that we have 2 routes to market in America. Our access devices are channeled through Microline, and our scissor and instrumentation business is channeled through Adler, who are based in 11 states in the southeast of the country. We historically have gone through an alliance for our scissor business, which covered the whole of the US, but has proved to be ineffective. It was very disappointing. We thought we had a real opportunity there to capitalize on that. And so from the scissor business perspective, what we're doing is looking at key states and areas that buy into the sustainability market, that understand the messaging that we're getting across, and our international team are working with the dealers that we cherry pick to build our scissor business and try and get the volumes back up again to where we need them to be. On the access device business, so what we've learned over the last year or so is the very difference in selling, the selling strategies and the way they sell in the US compared to where they sell in Europe. And a lot of this is on commission-only salespeople or highly commissioned salespeople, and they're looking for the quick wins, where the access devices take a little bit longer. But the advantage and what we're beginning to demonstrate to the American companies is that if you take the time and you win that business on sustainability, on quality, then your business is not endangered by cheaper alternatives coming into the marketplace. And that is beginning, that training program that we're doing in the US, and we're at their national sales meeting in a couple of weeks' time, and then co-traveling with our sales team. We expect that to be able to start generating real traction in the US. And then on the back of that, and I think there's a question about Logitube later, but with registration of Logitube in the US, which is it's normally a 90-day process for a Class 1 device. We expect that to be the tail end of this year. And that will open up a real opportunity. There are, out of the 500,000 procedures a year, 220,000 of them are done in the US. And that's a significant opportunity for us to put right our US business.
David, why don't we come to the Logitube question now then, in that case. One investor had joined late, so wasn't sure whether, I know you discussed it in the new product development slide, but could you just give a quick rundown of the development and then the market reaction to Logitube and Yellowport Elite range?
So Logitube was initially, the gastric calibration tube was a product that Elemental sold from a third party. We bought that product in-house and own branded it. We launched the product in December. So this was a project that started in September last year. We launched it as a Class 1 device in December in the UK. And that now has, so we got a much better margin for the product. And we've maintained a significant portion of the business we already had and now growing again. We also launched the product last week in Europe, and we've started to receive initial evaluation orders there. So this device is a really good pathway for how one of our strands of our R&D strategy works now, is that it's picking up products that allow us to bring manufacturing in-house, utilize capacity, particularly around injection molding, particularly around assembly and the clean room. So we gain extra efficiencies there. We gain more margin because it's an own branded product, and then we can filter the product out to the rest of the world. Our first stage, as I say, is Europe and then into the US.
David, if we stay on new product development and the pipeline, one investor has a few questions on this.
Okay.
So one of them was, how many projects do you have in the new development program?
That's a difficult question to answer specifically, in that each project is then broken down into other projects. So if you take the cost down project for universal valve, there is changing the bellows to TPE. There is combining the duckbill valve and the petals together and then changing them to TPE. And then there are taking other components out of it. So within that one project, there are probably another 5 or 6 different projects that we will gradually work our way through on throughout the rest of the year. But primarily, we've split it into 3 pillars. So there's sort of the enhancement of our existing product portfolio, and then there's the materials and cost down projects, and then there are the new innovations like the illuminated Logitube and some of the low-cost scissors and developing projects like that. So sort of it's very hard to give you a specific number, but we're working in three pillars at the moment.
Are you able to give an indication of when the launch date would be for the illuminated Logitube and the new scissor and potentially any other products? So
the advantage of the illuminated Logitube is still a Class 1 device, so that will be a very short time. We would hope to launch that at the tail end of this year. The low-cost scissor would be a new classification Class 2A device and would probably take us, it would probably be towards the end of 2025 by the time we got that one to market, simply because it has to go through the full regulatory process.
And then touching on robotic surgery, the investor asks, what are you doing to increase your presence in the robotic surgery sector?
Okay, so interesting question that. So within robotic surgery, or let me start by saying every robot, regardless of whether it's Da Vinci or CMR or transenterics, requires access devices to gain entry to the abdominal cavity. We so happen to make access devices that work with every robot, so we're well positioned from that perspective. We work and we have a good relationship with CMR, and we are talking to them about a number of projects, about a number of collaborations. India is a good example of that, in that although we sell our product through Peters Surgical, it's on the back of the installed base of CMR robots that our business has gained traction. And so we go into the accounts where they have a robot, we convert that to Yellowport, and then we roll it out to the rest of the hospital. So it's a good strategy for us and a good partnership.
The investor's asking about forecasts for 2024, 25. I don't know whether that specifically be about robotics, but I think you could probably only really point people in the direction of where the market forecasts are for for 2024 for the whole group.
Yeah.
I don't know if you want to outline what the market expectations are. I think revenue growth to go from 12 to 12.4.
Yeah.
And as I'm aware, there aren't any forecasts in the market for 2025.
No, we as it stands today, we don't have a forecast in the market for 2025. We're working on, as John alluded to, we're working on improving the facility back in Leeds and driving the efficiencies through that and seeing how the margins come through. These things, whilst in theory, should on paper happen quickly, they tend to take longer to filter through, and we just want to make sure we get that dynamic right. I don't think I'm qualified to give you a forecast for robotic surgery.
What about growth in could investors expect from Asia, notably India, Pakistan, China? What are your aspirations there?
So we're really excited about the APAC region, primarily India and Japan. There are strong drivers. So Japan have in recent months, they've taken on our reusable instruments. They've got registration for the Yellowport Elite range, and that's beginning to gain traction. They are, they've grown their business sort of double digits most years, and we expect that to continue. India is a real opportunity for us. It's a population of 1 billion, at least, sort of 100 million of them are wealthy and can afford private healthcare. Their healthcare system seems to be adapting well to the sustainability drive that we have. The Indian government is quite proactive in sustainability, and so we see that as a real opportunity for significant growth. At the moment, the business is very small, so I could stick a whopping percentage on it, but it wouldn't really mean a great deal at this stage. It's sort of, I think, by the end of this year, we'll have a clear indication of how fast we can grow that business.
Sticking to kind of geographical spread of the business, are you looking to target Africa or Oceania?
I think our next step would probably be towards South America. They have well-established healthcare systems with laparoscopic surgery being performed routinely. Our challenge at the moment is around bandwidth, and sort of we learned from our experience when we tried to conquer the US all in one go, that sometimes it's better to be narrow and deep than to be spread too thinly elsewhere from a bandwidth point of view.
There's an interesting question here about the market. What do you think would be the impact of drug treatments on obesity compared to surgery?
Yeah.
And do you think that will have an impact on future surgical equipment sales?
The honest answer to that is no. I don't think there will be a negative impact. We're all getting bigger. We all eat too many McDonald's and Burger Kings. Every treatment that is every treatment that is not a bypass or a gastric sleeve requires self-discipline by the patient to diet, which is something they've clearly failed to do. Hence the reason they're having the surgery or taking the new medication that's coming out. Some of the medication is proving to be effective, but ultimately at the moment, the ideal solution is a bypass or a gastric sleeve. And I'm absolutely convinced that those numbers will continue to grow as we continue to grow.
Just back to robotics, an investor's asked, CMR are a minor player in robotics, but are you doing anything with Intuitive Surgical Inc. and the Da Vinci systems?
Not specifically with Intuitive. They are, for a company like us, they're a hard company to engage with. We have had historically, we've had discussions with them about instrument development. You're right, CMR are a minor player in robotics, but they are number 2. And they have a very aggressive plan to increase their installed base. And we work on the theory that there are opportunities for us to develop instrumentation for all of the robotic companies. We have ongoing dialogue with a number of them, albeit at a very low level at this stage. But CMR is as much a commercial relationship as it is a product development relationship.
Okay. There's a question about global forecasts for 2024-25. I imagine that that's a question regarding the global market, but is that the kind of data you would have, or is that not out there?
Well, there's lots of data out there about how markets are going to grow by sort of X percentage per annum and things like that. And depending on which data sheet you're looking at, those numbers vary. So, I think, what you can comfortably say is the sector we're in minimally invasive surgery is not going to go away anytime soon. There are more procedures that are being adopted as laparoscopic procedures. It may be that, down the line, we looking at different specialities as, minimally invasive spinal surgery and things like that begin to grow. And we can see how our technology can impact in those areas. But I think we're in a comfortable position from our market sector that we're in, and we will see continued growth year on year.
Thanks. I think apart from one comment from an investor, that's the end of the questions that we have online. But the investor just says, to say thank you, glad that the efficiency work is ongoing. They agree that our research and development is very important, and can imagine that a hit product could resolve a lot of issues. But that ends all of our questions from the investors.
Thank you.
Perfect. That's great, David, Jonathan. Thank you for addressing all those questions from investors today. And of course, the company can review all questions submitted today, and we will publish those responses on the Investor Meet Company platform. But before redirecting investors to provide you with their feedback, which I know is particularly important to the company, David, could I please ask you for a few closing comments?
Thank you. Yeah. Firstly, thank you everyone for taking the time out today to sit through our presentation and sort of give us the exceptionally good questions. Really interesting. So what I would like to leave you with is that the company, from a revenue point of view, is in a really strong position. There is significant demand for our product, and that is continuing. We have sort of a pipeline of new products which will help generate further sales throughout the year and into next year. We recognize the challenge that we've had internally, and we put in place plans to improve our efficiencies, to drive margin. And that's a constantly evolving program. We're constantly looking at different ways that we can improve the facility and keep costs under control. I think we've proved that we're a reliable partner to a lot of our suppliers and also to our distribution network as well. We're providing the distribution network with new products, and our suppliers have confidence in us by renewing our agreements. So I think that's a really strong vote of confidence for the business. We also have excellent relationships particularly in the UK, but around the world. We're working with the Belgian government on a Green Deal there. We work very closely with the private sector in the UK, and we're leveraging that to capitalise as they do more and more of the waiting list initiatives. And as I say, sort of the operational benefits that we have as a business, we'll see those filter throughout this year and into next year, and it will be a very different picture as we go forward. So thank you very much for taking the time to talk to us today, and look forward to seeing you in September.
Perfect. David, Jonathan, thank you once again for updating investors today. Could I please ask investors not to close this session, as you will now be automatically redirected to provide your feedback in order that the board can better understand your views and expectations. This will only take a few moments to complete, and I'm sure will be greatly valued by the company. On behalf of the management team of Surgical Innovations Group PLC, we'd like to thank you for attending today's presentation, and good afternoon to you all.